What's up, traders? Hope you're having a good week. This morning is yet another morning of a bearish day. This is a different year than 2020 for sure. A lot of people are getting a little nervous because we just don't constantly go up every day like we did back in 2020, but it's really not that bad in the grand scheme of things. Times like this, when the market is not being nearly as exciting, is a great time to do research on long term positioning. And for that reason, I've been going back and refreshing my knowledge of sector rotation. Now, I've known about sector rotation for many years now, but I've come to really appreciate it this year because of what has happened following the COVID crash. And I'm going to show you what I mean and what it means for the future and how long term investors can position themselves. So, sector rotation is basically the movement of money from one industry group to another. And this follows the business cycle, the economic cycle. In other words, let's say that energy prices are very low. Well, that's going to mean that transportation is going to be very profitable because their input costs, their energy costs are lower. One of the key fundamental ideas or theories behind sector rotation is that out of market bottoms, certain sectors lead. And those sectors are technology and consumer discretionary. And what does consumer discretionary means is things that people buy like luxury goods, things that people don't need. They choose to buy them rather than have to buy them. Look, so that's basically what consumer discretionary is. This is the diagram that shows the theory of how money moves in different stocks of different sectors as the economy and the whole market itself moves. So basically, how you read this is we look at the red line. At a market bottom, the end of a crash, what you'll look to lead in that time is what is up here: finance, technology, and cyclicals. And cyclicals is another word for consumer discretionary. But the key thing to think about here is that, in theory, at a market bottom and out of a market bottom, technology and finance should lead. The next, as you are growing on that skepticism, as the bull market is beginning to trend or in the middle of the trend, technology will lead, but also industrials and materials. Materials can also be seen as commodities. Companies that make things, companies that mine things, those are the industries that you look to lead as the bull market begins to mature. Then, as the bull market comes to a high point of maturity or close to a market top, in theory, you'll look for, again, the materials, commodities to lead. But you'll also, very key point, notice energy should begin leading. And then that is actually a pretty good indicator of a market top. The next things to lead would be consumer staples and healthcare. And consumer staples are things that people buy no matter what the economy is doing: toilet paper, toothpaste, those kind of products that it doesn't matter if you're out of a job or if you think the economy is going to crash, you still need them and you're still going to buy them. It's not to say that these companies are going to be incredibly profitable and their stocks are going to go up tremendously during this time. What it means is that these stocks will outperform the market as a whole. So even if the market is going down from a market top, these stocks will not go down as much. And so if you're trying to position yourself at a market top, rather than going to cash and potentially missing out on the move, you may want to move into these more defensive sectors. After the bear market begins to make its turn and consumer staples and healthcare are beginning to outperform, a lot of money will shift into very defensive stocks, which would be utilities. And the reason people shift into utilities is because they pay very good dividends. They're very stable companies. They're not going to go out of business. And so these begin to outperform at the end of the bear market cycle. So I highly recommend you do a Google search for sector rotation and read up on this and understand it. That's the basic gist of what happens, or in theory, of sector rotation. The book that I have and own and read and is very, very thorough, gives some great ideas, is this book by John J. Murphy. I don't know the last time it was updated, but it was definitely updated post 2008. And so this would be my recommended pickup for your study of this. Very in depth, very detailed. In the book, it also references this website right here, which is perfcharts.com. And what this lets you do is a very cool tool is see the different ETFs, the sector ETFs like the XLY, XLK, etc., and then map them based on a certain day cycle and how they perform relative to the S&P 500. So what I did on this was I set the day period down here to 90 days. And we're going to start this on the 25th of March, 2020. We're going to see it right after that market bottom. And what we can see here with the bar graphs is the relative performance of these sectors coming out of the market bottom. Now, what's interesting, and this is looking, of course, 90 days or basically a whole quarter forward from that low. So from the low, it's very clear to see what sectors led: the consumer discretionary and the technology. These are exactly as sector rotation theory would predict. And we know in hindsight that, of course, technology led because Apple, Tesla, Amazon, all those sort of things. Also, by the way, Amazon is a consumer discretionary. People don't necessarily buy everything they need. They buy a lot of stuff they don't need on Amazon. So it's consumer discretionary. And what's really cool about this tool is we can go forward and we can see how the market cycle develops as we go forward in days. And so throughout basically the summer and into the fall, we see that the sectors that are leading are still discretionary technology. But remember from our market cycle, after a market bottom, after the bull market begins to mature, what the sector rotation theory predicts is that industrials and materials will lead. And sure enough, following technology and discretionary, those are the two sectors as the bull market matured that were leading. And so if we go forward, they're still leading. And now we're coming into, I'll skip ahead a little bit. Let's get more into the end of the year. Now, as it matures more and more, again, industrials and materials have now taken the lead, exactly as the theory of sector rotation would predict. Financials starting to come in now. Now, here's what gets interesting. Now, towards the end of the year, September and into January, and even more so as we go into this year, energy is by far the greatest outperformer. And so, again, the sector rotation theory says that at the bottom, technology and discretionary will lead, followed by industrials and material, then energy. And energy can indicate the potential of a market top. Of course, going to be oil and things like that. It's not to say that the market's going to crash, but this is what the theory predicts. But let's not worry about if the market's going to go down. The question is, what does the theory predict after energy leading? Well, that was, of course, consumer staples and healthcare, which have, over the last quarter, actually underperformed. Another website that's great to go to is etfdb.com. And so I went ahead and pulled up the holdings of the XLV, which is the healthcare sector ETF. The top holding here is Johnson and Johnson. And then you have United Healthcare Group, you have Abbott Laboratories, AbbVie, Pfizer, basically all the pharmaceutical companies you can count as healthcare. And J&J is interesting at the top of this list because they also make a lot of consumer staples as well. And a lot of the stuff that you buy is, Johnson and Johnson, like products for, teeth and toothbrush. I guess lots of things they make. Consumer staples is XLP, and this is the list here. These again are things that people buy no matter what. Procter and Gamble, huge. They make pretty much everything, like your clothes washing, your dishwashers, or your products that you use. Coca-Cola, Walmart, Pepsi, Cigarettes, there's Altria in there and Philip Morris, Costco and Kimberly Clark, a lot of toilet paper made there. Cisco, which is food. So consumer staples are big. So the top of those lists are J&J and PG. And I actually happen to really like those stocks and what they're doing right now. Both of them, as of making this video, have a dividend yield of 2.55%. Both of them do. Now, that's not spectacular, but it's a lot better than putting your money into a savings account with less than 1%. I also like it technically that Johnson & Johnson has pulled back to the Ichimoku cloud, which is, if we take it from the bottom here up to here, we're getting close if we get down to here with our 50% retracement, maybe the 154 area. Procter & Gamble, it has a little bit of a longer term halfway point that is starting to come to from basically the COVID low. It's pulled back almost 0.5%. Like I said, both of them have a very good dividend yield going forward. So remember what we talked about with finance, technology, and cyclicals or consumer discretionary leading at the market bottom, followed by industrials and basic materials, energy, which is definitely leading right now, in theory, leads at a market top. And then as the market begins to rotate, consumer staples and healthcare. Again, this is just theory. I highly recommend everyone read up on it themselves, do the research. This is just a cursory, high-level view to get you started, get you interested in this theory of sector rotation. But if you are looking to get defensive, those are the ways that I would start looking at either the consumer discretionary and healthcare ETFs, or go in there and look at the holdings of those two large cap ETFs and find companies that you like. And it can also be a way to add to your dividend portfolio. So, hope you guys got some useful information and have a great week. Trade wisely.